Good morning, everyone. Welcome to our Friday morning trading session. The end of another work week. I'm using air quotes when I say work. Although, trading is work in its own respect. It's not physical labor, to be sure. But mentally, you have to be pretty tough. All right, let's take a look here what's going on with the NASDAQ this morning. Big run up yesterday. The market went stagnant after that. A little bit of a sideways range. We're testing the bottom end of the trading range just at the moment. Trade forecaster suggesting we are going to be in trend mode for the better part, or just over 2 hours, 2.5 hours. We got a first micro-macro cross to sell here just out of the open on the hawk. Trend change signal here on the falcon as well, right around the opening bell, maybe a moment before. And here on the raptor, nothing just yet, but now that we've breached the cloud, we're going to be looking for a reversal signal and a chance to get that cloud crossover signal. If they give it to us. Or are they going to fall out of bed right out of the open? We still have the rather substantial opening gap from yesterday's session, still sitting down here. The market never did get into that gap yesterday. That would be a very healthy target. Okay, well, good follow through on that first micro macro cross and our trend change signal here in the Falcon. Still waiting on a chance to get short on the Raptor and the Eagle. It is still early. Okay, there's a pretty dismal looking cloud crossover here at the moment. Shrink it up a little bit so you can see it a little bit better. So we've got the clouds starting to cross. You can see the soft edge has crossed over. The hard edge not fully crossed yet. We are producing a warning dot. I would prefer to see maybe a little bit of a pullback, but we may not get it. If the market trend is strong this morning out of the gate, we may just see the market continue lower from here. About an hour before the open, we got this trend change signal, the number 2 soft edge sell. And of course, we're sitting right on the primary support zone. So maybe a bounce is looking likely. We have breached a significant swing point though. So I would say this is push number 1 lower. The market is going to owe us one more. So I think it's making more sense to look short at the moment. Crude oil fell off a little. The euro pretty much sideways. Those are the other 2 markets that I'm also keeping an eye on here at the moment. All right, so we've got a macro pullback now here in the hawk. I'd probably set up the trade something like this. And I may try to run it out. I'll throw a break even down here near the lows. We're working a possible late filter entry here on the Falcon. The late filter entry occurs when the filter goes out of sync. It needs to come back into sync, but the whole time that the signal is forming, the trend line does not change color. Now it's around almost quarter to the hour, my least favorite time of the day to trade, but we'll see. See whether we can hang on here long enough. Alright, so as far as the Falcon is concerned, the late filter entry signal has been spoiled because the trend line now has gone green. We're working a 4-arrow consolidation here in the hawk, which is encouraging because a 4-arrow consolidation tends to be a very strong signal for the hawk. Okay, here now on the Raptor, we're getting ready for the number one, the cloud crossover signal. Now you're going to notice that the Raptor itself is not going to print the signal at this time because the hard edge of the clouds have not crossed. This is why you need to be able to identify the signals independent of the prompts as well, because this could still be a number one cloud crossover signal, even though, technically speaking, it's not a perfect signal, meaning the hard edges haven't crossed yet. See, this one worked out very well for us because the hard edge crossover coincided after the pullback. But sometimes we'll have most of the pieces in place but not enough to actually print the signal. It's a tough morning this morning. They're really, really fighting it out here. Obviously, the buyers have been very strong the last couple of days, so it's no small feat for the sellers to try to step up here and push the market lower. Oh, thanks, Tony. Tony says, we got Red Star News at the top of the hour. Let's see what's going on at the top of the hour. Oh yes, existing home sales. That could spark the market a little bit, give it a little nudge. Um, the fact that we have a news report out at the top of the hour raises an interesting question. People always wondering, you know, what drives the market? Why did the market rally? Yesterday, perfect example. Huge rally, as we know, yesterday, right? The market took off, just kept pumping all day, and it left everybody scratching their heads as to why. Why did the market go higher? There was no significant news yesterday. There was nothing noteworthy to spark a rally like that. Normally a rally like that has got some really good news behind it. You know, Apple earnings are huge, or Tesla invented a minivan, or whatever, right? Okay, here's our signal. And I'm only in with a single here, so I think I'm going to do the same thing. I'm going to see if I can't run it out. So the market makes a huge rally yesterday for no apparent reason. And everybody's left scratching their heads saying, why? Why did the market do that? The short answer, because it can. It rallies just because that's what the markets do. And the news always, and I do mean always, fits what the market does. News reporters see the world through the filter of the news, right? If something happens, there has to be a news event to account for it, and it's their job as a reporter to try to figure out what that is. Well, the markets don't work that way. The markets are here to facilitate trade. It's not quite as obvious when you're using the stock indices as an example, but let's say we're talking coffee or cocoa or soybeans. There are suppliers and there are consumers of these products, and now we're talking on a commercial scale. We're not talking people like you and I that go to the grocery store and buy a pound of coffee. We're talking about Starbucks and Tim Hortons and these huge coffee roasters that are buying tens of thousands of pounds or hundreds of thousands of pounds of coffee a year. General Mills that buys millions of bushels of oats and corn and soybeans to make their cereals and their various products. they have reasons to be buying and selling these commodities. They use them as a hedge against price changes. Likewise, the producers will use them as hedges. So people like you and I are just, I don't want to say the grease between the wheels, but very often it feels like we're the grease between the wheels. But we're here to facilitate trade. We're here to essentially ride the coattails of the market makers. And like I say, it makes it a little less sense when you're talking the stock index, because the stock index isn't a real thing like corn or cocoa or soybeans or cows or whatever. But if we're looking at a real commodity, and we're looking at what's happening, say, in the soybean market, and we can say, the commercial or pardon me, the fundamentals of the market are suggesting that there's a whole lot of soybeans on the market. Therefore, soybean prices are probably going to come down this year. And if we look for that, then that puts us in a better position to ride the coattails of the people who actually trade the market for a real reason other than to make money. That was a very convoluted explanation. I hope it made sense. Oh, I agree here. Mr. Buckaloo says a very profound statement. He says, I'm thinking the news is used by the hedges to cover their actions. When the market moves center or counter to the news, it's always because it was baked in. And he's using air quotes when he says that. And I agree wholeheartedly. The news is a very important tool, if you will, especially for the stock market. I don't think people realize how much the news affects the value of things like stocks or commodities, even for that matter. The stock indices definitely. The commodities markets probably to a lesser degree. I forget the fellow's name at the moment. He wrote a very profound book about trading on Wall Street, and I'll look it up. But that was essentially his take on the market, is that the big players in the market, hold on here a second, I need to multitask. The big players in the market will use the news to create demand for their product. You've heard about, I'm sure, about the Wyckoff trade cycle. Richard Wyckoff, way back in the 1930s, or before, actually, proposed that the market went through several phases. The first phase was called accumulation. This is kind of when the people in the know started buying up a stock. Then they would rally the market, and this would be called the markup phase. After they sold off their accumulation, it went through a distribution phase. And then the market would start heading lower. During the distribution, or pardon me, I just did this in reverse. They would accumulate stock. They would put out news about the stock, the market would rally, then they would distribute their stock, make their profit, and then the value would decline, and after which the whole cycle repeats itself. If you've ever dabbled with penny stocks, you've no doubt heard the words pump and dump. Same idea, except on a much, much larger scale. And the news has been accused of doing exactly that, of hyping certain markets, making them, more attractive than they really are, to get the general public involved, and then again the people in the know take their money. See you later. And everybody else is left holding the bag. So I'm sorry, I'm not very articulate this morning, but and I will look up the name of that book. Yeah, the guy's name just popped right out of my head. But to prove his point, he actually called market tops for several years. It was like 1972 and 1980 or something like that. So the fellow certainly knows what he's talking about. Yeah, like Tony says here, he says Kramer has made a fortune doing just that. If you've ever seen his show, he's always promoting something. Way back in the day, Ken Roberts isn't as influential as he used to be, but he was a big deal in the whole commodities world 20, 25 years ago. Actually, I guess it's going on 30 years now. Darn it, I thought we were going to be able to ride out that little swing, but it didn't happen. Okay. Ken Roberts had a, pardon me. Ken Roberts had an option trading strategy, and I'm using air quotes when I say strategy. The idea was that you would sell deep out of the money options. The acronym for deep out of the money options is DOOM, and for good reason, because that's usually what happens to your account when you try to buy these things. They're so far out of the money that the chance that the strike price will ever be hit and that they'll actually be worth anything is slim to none. And as they say, Slim just left town. So he was a big promoter of these deep out of the money options, especially in the silver market, which he felt was extremely undervalued. It never occurred to me, and I'm sure it didn't occur to anybody else either, who is writing all these deep out of the money options for silver? Who is the underwriter for those? It's the perfect, well, I'm going to say the word scam, but it's the perfect scam. You tell people, hey, this is a great strategy. Buy these deep out of the money options. They could be worth 100 or 1,000 times what you paid for them. And in theory, they very well could be, especially in a silver market. You could easily buy an option, 10 strikes out, spend $600, and that option could be, well, it could become worth 6,000 if silver could rally 10 strikes or 20 strikes. But it won't. It didn't. And so here you are writing silver options way out of the money, charging $500, $600, $700 for these options. And all that money goes into your pocket. Yeah, Stephen, regarding my cereal analogy, he says, I thought all cereal was sugar manipulated in a different way. Pretty much. There's a lot of truth in that statement, too. I remember watching a program, and the fellow said, if it's man-made, don't eat it. I thought that's pretty much sums it up, doesn't it? If you want a healthy diet, if it's man-made, don't eat it. Of course, that applies to breads and cookies and cakes and cereals and pasta. All these good things. Why couldn't those things be good for us? My favorite food analogy, and again, I'm sorry I forget the author, but he said, real food does not come in through a car window. That's also a good rule of thumb to live by. In case you're wondering why I'm jabbering on about food, is we're not getting a follow-up signal here in the Hawk, where we did pretty well with our macro pullback / 4 arrow consolidation trade. It has since drifted into yellow bars, so we're kind of on hold here. We might be watching the market reverse on itself. I'm not sure just yet. Yeah. Oh, thanks, Tom. Tom says, I love your trading monologues. All right, here we go with the Raptor now. We're getting the proper #1 signal. Now, I'll tell you the truth. This is going to be a little bit dicey because we may be looking at a double bottom. So what I'm trying to do is I did a little mini second push there. I placed my entry south of the primary support. I've crossed my fingers and my toes. And maybe, just maybe, we'll see them try to slip a little lower here. I don't mind, trying it with a single. I placed my stop above this morning's high, which is probably a fairly safe place to be. Okay, so you can see they're struggling here a little. And darn it, if I didn't sell it right on the low. Well, I guess somebody's got to short the low. Okay, they're going to give it another go. I'm debating trying to run this one out as well, or whether I should just try to take my profit and be done with it. Boy, oh boy, they don't want to go below 54.35 half. What's up with that? And yet another hesitation. Doggone it. Come on, get down there already. So obviously 54.35 half, a real obstacle for the market. Probably a price you want to make a note of. Tony making a comment here about the daily NQ. He says, I just took a look at the daily NASDAQ, and it does not look like it's running out of gas. How high can this market go before a correction? And that's what everybody is asking themselves. Now, you know, if we go through the whole Wyckoff thing that I showed you, that way back here we had, oops, my tool is not working. What's going on? Uh-oh, did I break something? Ah, there we go. Okay, that way back here, what the? Oh, I see, it doesn't like to print outside the chart. Okay, so way back here we have the accumulation phase. Now we've got the markup phase. Well, now we're kind of going sideways, aren't we? Could this be the distribution phase? Maybe. A helpful tool is sometimes to watch volume in this type of instance. Just your plain Jane volume indicator. And what you would be looking for is abnormally high volume on small bars. That tells you that there's a lot of trading going on and not much happening price-wise. Now, volume, of course, is very difficult to interpret. Some people like to use here we go, on balance volume. It's kind of an interesting tool. It plots volume relative to the day. So if the day finished bullish, it takes all the volume and plots it higher. If the day finished bearish, it takes all the volume and plots it lower. So if this is the case, well, we've kind of had a spike in volume here, haven't we? We've had a spike in buying, if you will. So it's a good question, Tony. There's the old trading expression that says sell in May and go away in relation to the stock market. So I think there's a lot of traders looking for a correction, to be sure. I don't think it's going to be a huge correction, of course. No sooner will I say something like that than the bottom will fall out of the stock market. Ah, right. That doesn't help matters. Ken reminding me today is an option expiration day. And that always makes the market behave a little wonky. That is a technical trading term, by the way, wonky, in case you were wondering. All right, so we've got, so far the seller's still holding the market, but honestly, just barely. We've got something resembling a bear flag. This high up here, muy importante. We cannot see the market break that, or at least not break it significantly. That could be bad. Just doing a little housekeeping while I'm waiting for the trade to turn around. They're brutal. All right, I'm going to bring the stop in. Wow, the buyer's coming out of nowhere here. I'm really debating whether I should keep my stops back above the high this morning or whether I want to take the early cap out. Remember, a stop loss is not a loss unless it gets hit. Of course, my decision making would be a whole lot easier if we would get another little swing printing here. If we could actually get a bar to print lower. Wouldn't that be something? Hey, David. David, a new Raptor owner. Congratulations. David asks, are there any videos which explain how to install and use the Trade Manager? If so, where do I find them? Okay, I'm going to direct you to Ben. If you don't have Ben's email just yet, I'm putting it in the window here. If any of you have technical questions like that, Ben's your guy. The Trade Manager, though, while we're waiting here, I will run over the Trade Manager for you. And I don't know, I am really torn. All right, I'm going to give it a couple more ticks. There we go. We'll put it back near the high of the morning. All right, so as far as the Trade Manager is concerned, the Trade Manager, here we'll use it on the Falcon here. The key components to the Trade Manager are down here. This is what we used to call the risk manager part of Trade Manager, because it does exactly that. It manages your risk. If you click on this risk percent button, it will cycle between manual mode and risk percent mode. When you are in risk percent mode, which I highly recommend, it will default to this value right here. This means that no matter how you set up your trade, so let's say we're looking at this signal right here. No matter how you set up your trade, whether you place your stops really tight or whether you set your stops wider, your risk amount is always going to be the same. Did you notice that? That whether I place my stop up here at $440 or whether I place my stop right here, the risk amount doesn't really change. It's 2% of my capital. Now that's my capital. For you, it might be more, it might be less. If you're just looking to get your feet wet, you don't want to trade a lot, you're just kind of getting used to trading, you can default to the manual mode, in which case it will rely on this quantity right here. And that means whether your stop will be based on, or the dollar value of your stop will be based on how far you place it from your entry. So in this case, it would be a relatively small stop. In this case, it would be a more expensive stop. But if you're trading a market like the NASDAQ, they're both still very affordable. The features down here, the T1%, T2%, T3%, this allows you to preset profit targets. So let's say you're wanting to trade, you're going to trade 3 contracts. You're going to force the market to, or Trade Manager to take 3 contracts, and you want to take a third off at target 1, you want to take a third off at target 2, and you're going to leave the last third as a runner. So I've already preset my target 1 at 20 ticks. Let's say I'll manually set target 2 at 40 ticks, and then target 3, of course, is 0 ticks because it is a runner. Now when I set up a trade, Trade Manager automatically implements my preset profit targets. You can also click your targets by toggling here, click targets enabled or tick targets. When click targets are enabled, you can manually set your profit objectives. And Trade Manager will split it up according to your strategy. There's also 4 different order types. By default, we use the stop order 99% of the time. And then we get into the profit manager portion of Trade Manager. That's this little tool right here. This is where we've got all our different stop strategies. And you can enable them. What this means is that if the trade is live and you have an active stop, let's say your stop started up here, and you get filled, Trade Manager will automatically, if this is enabled, Trade Manager will automatically take your stop from up here and roll it here down to the blue dot, and it will continue to adjust it according to the stop strategy that you have selected. All right, so it will continue to do that for you. Like I said, there's 16 different stop strategies in here. They're all customizable, so if you want to make them more or less aggressive, you can change the values, click accept, or preview if you want to see what it's going to look like. Let's say you want to see what parabolics are going to look like. I don't know how well you can see these orange hash marks, but that would be the parabolic strategy. If you say, oh, I like that better, then just click accept, and now Trade Manager will manage your trade according to the parabolic strategy. All right? And that's the Trade Manager really in a nutshell. We do have the buy and sell market buttons up here. There is a panic exit button if you know, the trade is doing something totally unexpected and you just want to flatten everything on your Falcon. That button will do that right there. This little break even button is for an active trade. The OCO feature, if you turn that on, let's say you're looking at this market and you're saying, wow, that's looking like a sideways range. I want to bracket it. I want to sell below and I want to buy above. The important thing to remember when you're using the OCO feature is that you're not going to use this tool down here. Rather, you're going to right-click on your chart, and now you're going to select your order. Now notice the quantity defaults to whatever the quantity is here. So I've got 3 contracts set. If I don't want that, then I better change that. So I'm going to sell down here, and you see it's OCO1, and let's say I want to buy up here. And you see they're linked. It's OCO1, OCO1. If I toggle the OCO feature, and let's say I want to bracket a bigger range. I want to bracket this range up here as well, so I want to buy above there, and I want to sell below here. Now I have another set of OCO orders, and you'll see that these are marked OCO2. Because these orders are linked, if I cancel one of the orders, the other corresponding order will cancel. And of course, if I cancel the other order, then the other order cancels. The buy and sell market buttons will default to this quantity as well. That's something you need to keep in mind. But there's your crash course in using the Trade Manager. David asks, how do I place a limit order? Okay, so let's say you're anticipating the market is going to bounce off of the median support and resistance line here. Change your order type to a limit. I would suggest you go to manual mode, because unless you're going to run a wide stop, risk percent mode is going to give you a whole lot of contracts. Here, I'll show you. So let's say we want to short 54.46 half, and you're prepared to give it 3 points. So you can see risk percent mode always defaults to in this case, 2% of my capital. Let's say you only want to short a single contract. Go to manual mode. Make sure this is set at 1. Order type limit. So there's your order. Here's your profit objective. Press submit. And now your order is pending, waiting execution. David asks, can you drag the stops and targets to wherever you want them? Yes, once your trade is active. So, for instance, let's go back now to the Raptor trade. So we have a live trade. I can change my profit target, right? I can move my profit target down here. I can change my stop loss and move my stop loss up there. Once the trade goes live, you can make those adjustments. But until the trade goes live, you cannot make those adjustments. That's what confuses some people, is they'll set up a trade say they're going to look to buy, and they set it up like this, and the market retreats and they want to bring their stop down and they're pulling at it, and why won't it move? Well, it won't move because it's not an active order yet. So you need to clear, and then you need to redo the order. It's you get used to it. It's really not a big deal to cancel the order. In fact, you can get quite fast at it. I remember a couple of years ago, somebody in the trading room commenting how quickly I could put an order on. It's like everything to do with your computer. You just get used to it. Remember when you buy your computer and you set it up and you always say, wow, this computer is so fast. And then a year or so later, it's like, come on, computer, hurry up. Because you're so familiar with it already that now it seems slow. All right, well, kind of a pretty slow pullback here. We're still nursing this trade along. The seller's got to step up here soon, though. Oh, Daniel says, what about the red bar buy on the Eagle? Okay. With the Eagle, we try to maintain the direction of the trading band. So right now the trading band is bearish. It is a red bar buy, you are correct. And it's certainly in sync with the ATR. But because the band is bearish, I would be more inclined to look for a sell signal. But this just kind of adds to the whole confusion the market has this morning. You know, we've got a bearish band, but we've produced a bullish signal, and the ATR is bullish. It's been a tough morning. We've done okay, but far from stellar. Like, we've been sweating this trade about a half an hour now. And it looks like it may finally be ready to give it a go, maybe. I'll set it there so it's not in the way of the market heading lower. I don't want to hold it up. All right, so we've got the count or the continuation signal now, our hard edge bounce. By the way, for you Raptor owners that are wondering about this counter trend signal here, the soft edge buy, the number 2 signal, I would not have placed a lot of stock in this signal, even though technically it is a number 2 soft edge buy. However, you have to remember what the counter trend signal tells you. First off, before you can go counter trend, you have to have a trend. I'm not sure that this little bit down actually qualifies as a trend that needs to be reversed. Even if you extended it to here, that's still a pretty moderate trend. Secondly, the trading band tends to get much wider before a reversal. Even the one from here, from the overnight, is pretty quiet. See, here the band is getting much more overbought, and makes it more likely that once we print the number 2 signal that it will actually stick and we'll see that reversal, which is what happened. But here, no, it's just very, very tiny. Stephen having a bit of a little fun with the keyboard here. A few expletives. Yeah, Steve's right. Yesterday, so many signals and nothing today. Such is the nature of trading. We are at the market's whim. Let me check that out. Tony's saying, oh yeah, look at that, the Day Ranger. Only 86 ticks today compared to yesterday's 208. Even on average, we're well below average. Hardly half of the average trading range, daily trading range. Floyd made a post here earlier as well that I missed. Floyd mentioned that he uses a 30-second chart with a volume moving average and ADX to see the slowness of the market. He says, I highly recommend it. All right, Floyd, let's check that out. We got nothing going on here right now. Let me build a 30-second chart. Remember, folks, all these bells and whistles are loads of fun. the objective, of course, is to make money. So if it's something that helps you make a trading decision, then by all means, use it. Otherwise, you don't want it to end up confusing you. Ooh, that color's going to be hard to see. All right, well, we may have to go back here a little ways to get into yesterday's trading. Just do a little comparison between yesterday and today. Sorry if this is making you dizzy. Almost there. All right. Oh, I see. Nice little spike above the ADX there. Oh yeah, that's kind of cool, Floyd. I like it. So I'm guessing here now, because Floyd hasn't told me exactly how he's doing this, but it looks like he's using the volume, the moving average of the volume, to confirm breakouts, and a rise above the 25, which is the standard level for determining trend in the ADX. So a rise above there would suggest a trend is present. And then when the market is below the ADX, or below that value, pardon me, it would suggest that the trend is declining. And today you can see we are pretty much trendless. We're not even getting anywhere. Oh, we got near a trend up here, but everything's still kind of tailing off. Yeah, like I said, it's yeah, Steve says he's using a 5 and a 15 moving average crossover. Again, you know, there's no end to the tools that you can use. You just go through your indicator panel and see the countless different indicators available. And you can go to the NinjaTrader forum and find even more indicators available. The thing is, it can become a rabbit hole if you let it. You need to remember the objective of the exercise is to make money. And in order to make money, you need three things. You need to have a decent signal. You need to have a way to manage your trade once you're in it. And you need proper money management. And of the three, the money management is probably the most important. And while we're waiting for this to play out, I might as well. show you what I'm talking about. Okay, here's a handy dandy little money expert from Indicator Warehouse. I'll shoot you the link here if you want to play with it later. And essentially what it's showing you is Joe Trader, Joe Average, and he's looking to make money trading. And you can see he's doing pretty well. He took $10,000, he ran it up to $14,000 over 100 trades, but he only traded single contracts because he did not want to overextend himself. But how could he have done if he used position sizing? Well, he could have taken that same $10,000, and while $14,000 is a terrific gain, he could have ended up with around $26,000, which of course is much better. But here's the kicker, here's the part that most people have a hard time with, is that you can be profitable even with a 50-50 system. Think about that for a moment. How much time and energy have you spent over the years trying to tweak your indicators, trying to tweak your moving averages? You know, fiddling with this indicator or that indicator, scouring the internet for any bit of information about how you can become a better trader, and yet you can make money trading 50-50 signal? How can that be? Well, it's because you're controlling your risk. You're never risking more than you can afford. The reason 90% of traders end up going bust, or perhaps that should be 90, well, we'll stay with the 90%. The reason 90% of traders go bust is they do not control their risk. They risk far more than they can afford, and it takes its toll. Whether it be death by 1,000 paper cuts or getting your head chopped off, this is how traders ruin themselves. I've told you in the trading room before, I've met two people who have each blown up a $20,000 account. One was a $20,000 account. The other was a $25,000 account in a single day. In a single day. How is that possible? How do you not have the common sense to rip your computer from the wall? That you will keep trading until you have decimated a $20,000 account. I've seen people do it with $10,000 as well. Not in a single day. Usually the $10,000 traders are a little bit more timid. But here's the thing. Okay, let's take a look at the example now. Okay, I like this equity curve. This is actually a very realistic equity curve. And these numbers are all generated automatically, so that there are no huge winners in here. I think the biggest winner, if we click on the chart, the biggest winner will find, oh, here's one that was $500. Okay, that can happen. That's reasonable. But typically, most of the trades will be like onesie-twosie types trades. Oh, here's it regenerated itself, but this is a fairly accurate equity curve as well. You start with 10,000, you actually lose a little bit, and look, with the position sizing, you actually ended up losing, looks like about $500 more than if you had just traded singles. But look at what happens when you start to consistently make a little bit more money. And once again, these are not huge winners. These are your bread and butter type winners. But by correctly capitalizing yourself, instead of ending up with $13,000 at the end of it all, you could be up $17,000. And you can do this time and again. You can go over this and over this. This one had a very good win run right through here. this was the final push, but you can see how correctly capitalizing your trades, again, just increases your earning potential from 13,000 to almost 18,000. This equity curve I don't like as much. While it can happen mathematically, and I actually met a person who did this. He started with $10,000. He actually ran it up to $40,000 and then ended up losing it all. So it can happen. It's not the natural progression. Here, from it looks like from about 30 trades out, the next 70 trades were all winners, and the compounding just increased the winning that much more. So while technically it can happen that instead of making about 14,000, you can make 24,000, it's not as likely. This isn't a bad equity curve as far as realism goes. Nice, earnings early on, catch a little bit of a slide toward the end there, catch a few stinkers. This one, there's no difference between trading a single contract or trading multiples, trading with the correct position sizing. And I think that's important as well, because what it's showing you, excuse me, is that you are no worse off. You're really no worse off trading this way. At the end of the day, you have everything to gain and really not that much more to lose. Here's another very interesting equity curve. Now, in spite of those spam emails that you get in your inbox saying, new trading system performs 93.7% of the time, Wall Street goes over the roof if they find a trading system that will perform 55% of the time. Why is that? Because they know the power of correct position sizing. They know if they have even the slightest edge on the marketplace, what a difference that's going to make to their bottom line. That's going to be huge. Now here's a great little experiment. What if you did less than 50%? Okay, again, this is one of those equity curves, not very realistic. You're hitting too many runners, not enough losers. It's possible, but not realistic. Okay, this, very realistic. Starting with 10,000, you hit some good runners, you had some stinkers. Overall, a pretty good winning run, even though this looks like most of our equity curves. You got a few good days, you get a few bad days. A good day, a bad day. A good day, a bad day. We're losing more often than we are winning. Let that settle in for a moment. You are losing more often than you are winning, and yet you are making money. Why? Because you've controlled your risk. And if you ever want to see how any of these trades split up, you can just click on the chart and you can compare the trades. And once again, you'll see that there's no home run trades. There's one for 350. Okay, we've done that in the room. Here's a $200 loser. Yeah, all right, we've done that in the room as well. But I'll let you play with that. But it's a great exercise. Here again, we are no worse off trading singles versus the position sizing. So at the end of the day, we start with 10,000, we finish 100 trades later at 9,200. Very realistic, but we are no worse off by controlling our capital. Again, a very realistic curve, again showing that we are no worse off controlling our risk. All right, here's one we are slightly worse off using the position sizing, but by now you can see that the potential for gain is that much better. Not very realistic. We'll go away from that one. this a pretty realistic curve. All right, so I'm not going to beat this to death. I should actually get back to my trade, see what's going on there. But I'll let you play with that and mull that over. And we're still kind of nursing this one a little bit lower. So we'll have to see what gives here, if they're gonna play nice or not. Yeah, like Robert says, what about the guy who advertises 90% win ratio? Seems like he's smoking something. I'll tell you guys right now how you can have a 98.5% win ratio in the E-mini S&P. And no, this isn't a joke. This is for real. 98.5% win ratio in the E-mini S&P. How do you do it? You trade for one tick. Yes, boys and girls, ladies and gentlemen, 98.5% of the time, the E-mini S&P will move one tick in your favor. Big deal, right? But that's how they do it. They run very tight profit targets. They run very big stops. And by doing so, you skew the win ratio. But does that mean you're going to make money? No, not always. Oh, during my little rant there, Floyd says crude just made a move, and it did too, just fell out of bed. Way to go, Floyd. Hope you picked up a few dollars on that. For those of you interested, Floyd sharing here with his little ADX volume moving average combo. He says he likes to see the ADX above 20 and the volume moving average between 200 and 400 before he thinks the market is in trend. So once again, so you guys can make notes if you're interested, the ADX above 20 and the volume moving average between 200 and 400. Hey, way to go, Floyd. 620 bucks on 2 contracts. Nicely done. That's a great way to go into the weekend. All right, gang, we're going to close up shop here. I've got a busy weekend. I don't know what happens in August that so many people are conceived, but I've got so many birthdays to go to in April. I'm going to another couple this weekend, and again the weekend after that. I was at some last weekend, some during the week. Have yourselves a wonderful weekend, and I will talk to you again on Monday. We'll see you then. Bye for now.